Gold just hit $5,266 per ounce. If that sounds like just another rally to you, you're already behind. Because this isn't a rally. A rally is when excited investors pile into an asset hoping to get rich. This is something else entirely. This is what happens when the professionals who design the financial system start quietly repositioning their money away from the very currencies they're supposed to be defending. Over 20% in 28 days. That's not normal for gold. Gold doesn't move like that. Gold is supposed to be boring, predictable, the thing your paranoid uncle talks about at Thanksgiving. But when silver jumps 60% in the same window, when platinum hits records it's never touched before, when all the metals move in lockstep like synchronized swimmers fleeing a pool, you're not looking at speculation anymore. You're looking at repositioning. And here's the question that should keep you up at night. Is gold actually rising, or is the dollar just falling apart underneath it? Because when the people whose literal job is to preserve monetary stability start hedging against the system they built, something has already broken. Stick with me until the end, because what's driving this move has nothing to do with greed and everything to do with fear at the institutional level. And that distinction might be the most important thing you learn this year. Part 1. The day gold stopped behaving like gold. Let's establish something right now. Gold breaking $5,200 isn't just a headline. It's a category shift. The kind of move that redefines how an entire market operates. On Wednesday, January 28th, 2026, spot gold hit a specific time-stamped record. $5,266.37 per ounce. That's not a round number. It's not 200, not 500, not a psychologically satisfying threshold that traders love to celebrate. It's an ugly, precise number that tells you this wasn't planned. This was momentum that couldn't be stopped. Here's what makes it different from every other gold rally you've seen in your lifetime. Gold gained over 20% in the first 28 days of the year. Let me repeat that for emphasis. Over 20% in less than a month. Gold is not a tech stock. It's not crypto. It's not some momentum play that teenagers are pumping on social media. Gold is the asset class that's supposed to be slow, stable, boring. It's what conservative portfolios hold so they can sleep at night. And yet here it is, moving with the velocity of a meme stock. Except it's not retail investors driving this. It's institutions. The futures markets are confirming the move, not fading it. That's critical. February contracts surged 3.4% to $5,255.30 per ounce. When futures traders, the professionals who make their living predicting where prices go next, are pricing in even higher levels for the coming month, that tells you they don't see this as overextended. They see it as underpriced. And then there's the cross-metal confirmation. This is where it gets really interesting. Silver didn't just rise alongside gold, it exploded, jumping almost 60% so far this year to a record high of $117.69 per ounce. Platinum hit a historic $2,918.80. These aren't isolated moves. When every major precious metal moves in synchronized formation, you're not witnessing market excitement. You're witnessing systemic repositioning. Historically, when metals move together like this, it's not because investors are optimistic. It's because they're terrified. In stable times, gold might rise while silver lags. Platinum might move independently based on industrial demand. But when they all surge together, it means capital is fleeing something, and gold is just the nearest exit. The narrative here isn't about traders getting excited about shiny metals. It's about money running away from paper promises and into tangible assets that can't be printed, debased, or disappeared by a central bank keystroke. This isn't speculation. This is survival positioning, and it's happening at a scale we haven't seen in over a decade. Part 2. The weak dollar wasn't an accident. Now let's talk about what lit the fuse. Gold doesn't exist in a vacuum. It moves in relationship to confidence in the currency it's priced against. And right now, the dollar is in trouble. Not the kind of trouble that makes headlines. The kind that makes analysts use phrases like crisis of confidence in their research notes. During gold's breakout past 5,200, the US dollar hit a near 4-year low. That timing isn't coincidental. It's causal. And here's where it gets political. President Trump made what analysts are calling a casual remark about the dollar when asked whether he thought it had declined too much. His response? He said the dollar's value is great. That might sound like a throwaway comment to you. To currency markets, it was a signal flare. Kelvin Wong, a senior market analyst at Oanda, interpreted Trump's remark as implying a broad-based consensus within the White House to have a weaker greenback going forward. Let me explain why this matters. Presidential rhetoric alone can move currency markets because traders aren't just reacting to what's said. They're reacting to what's implied about future policy. When a sitting president signals comfort with a weaker dollar, it changes the calculation for every institution holding dollar-denominated assets. It tells them that the traditional commitment to a strong dollar, the bedrock of US monetary policy for decades, is negotiable. And when bedrock becomes negotiable, capital starts looking for harder ground. Trump didn't stop there. He publicly predicted that interest rates would decline once he announces and installs a new head of the Federal Reserve. Think about what that means. He's not just commenting on the dollar. He's forecasting monetary policy based on a personnel change he hasn't even made yet. That's not normal. That's the executive branch signaling it expects to exert influence over an institution that's supposed to be independent. Whether you think that's good policy or dangerous overreach doesn't matter. What matters is that it creates uncertainty. And uncertainty is toxic to currency confidence. Ilya Spivak, head of global macro at Tasty Live, framed it perfectly. Given the tension between the Fed's mandates and the White House, I think the markets are just getting defensive. Defensive, that's the key word. Institutions aren't chasing gold because they're bullish on shiny rocks. They're buying gold because they're uncertain about the stability of the monetary regime. This is the causal chain. Rhetoric creates policy, uncertainty. Uncertainty triggers dollar sell-off. Dollar sell-off makes gold reprice higher. It's mechanical, it's predictable, and it's accelerating. Now here's where I'll be honest about what we don't know. Is this coordinated strategy or political improvisation? Is the White House deliberately trying to weaken the dollar to boost exports and manufacturing competitiveness? Or is this just Trump being Trump, shooting from the hip without thinking through the currency implications? We can't know for certain. What we can observe is the effect. And the effect is a dollar in freefall and gold breaking records. Gold didn't surge in isolation. It reacted to power signaling from the highest levels of government. And when power signals that the rules are changing, smart money moves before the changes become official policy. Part 3. When confidence collapses, capital runs. Let's zoom out from currency markets and look at the domestic economic backdrop, because what's happening with the dollar isn't happening in a vacuum. The American consumer, the engine that supposedly drives 70% of the US economy, is tapping out. US consumer confidence slumped to its lowest level in more than 11.5 years in January 2026. That's not a minor dip. That's a collapse in optimism about the future. Why are people so pessimistic? Dual pressure, a sluggish labour market combined with persistently high prices. This is the nightmare scenario economists call stagflation. Low growth, high inflation. It's the environment where traditional investment strategies break down because stocks need growth to justify their valuations and bonds get destroyed by inflation. So where does capital go when both stocks and bonds are dangerous? It goes to assets that don't promise growth but also can't default. It goes to gold. Gold doesn't pay interest. It doesn't generate cash flow. It just sits there, inert and expensive to store. But here's what it also doesn't do. It doesn't go bankrupt. It can't be inflated away by central bank policy. Its value can't be destroyed by a corporate scandal or a government default. In an environment where trust in institutions is eroding, where people are anxious about their economic future, where the rules feel like they're being rewritten in real time, gold becomes the rational choice. Not because people are optimistic about gold's prospects, but because they're terrified about everything else. Analysts had noted technical resistance for gold at $5,240 per ounce. That level has already been invalidated. Gold blew through it like it wasn't there. When technical levels that are supposed to act as barriers get shredded this easily, it tells you the move is driven by fundamentals, not chart patterns. The fundamentals here are simple and brutal. People don't trust the system anymore, so they're buying the one asset that exists outside the system. Here's the psychological reality that markets are pricing in. People don't buy gold when they're optimistic about the future. They buy it when they're terrified about the present. They buy it when they look at their paycheck, their grocery bill, their rent, and realize the numbers don't add up anymore. They buy it when they stop trusting that the people in charge know what they're doing. Consumer confidence at 11.5-year lows isn't just a statistic. It's a warning sign that the social contract between government, economy, and citizen is fraying. And when that contract frays, gold becomes the backup plan. Part 4. Why professionals went defensive first. Now here's where the story gets really interesting. Retail investors, regular people like you, are usually the last ones to figure out what's happening. By the time your uncle is telling you to buy gold at Thanksgiving, the professionals have already repositioned. And that's exactly what we're seeing now. Markets started positioning defensively ahead of Federal Reserve Chair Jerome Powell's remarks, even though the Fed was widely expected to hold rates steady at its January monetary policy meeting. Think about that for a second. The outcome was predictable. Everyone knew rates weren't changing. So why were institutions getting defensive? Because the uncertainty wasn't about what the Fed would do in January. It was about whether the Fed could maintain its independence in the face of White House pressure. Ilya Spivak's comment about tension between the Fed's mandates and the White House captures the problem perfectly. The Federal Reserve has a dual mandate: maximize employment and stabilize prices. The White House has a political mandate: get re-elected. Those mandates don't always align, and when they diverge publicly, when the president is openly predicting that rates will fall once he installs a new Fed chair, it creates a legitimacy crisis. Here's why that matters more than the actual rate level. Policy uncertainty is more dangerous than bad policy. If rates are high but predictable, institutions can plan around that. They can hedge, adjust portfolios, manage risk. But if the rules themselves are in flux, if the independence of the central bank is being questioned, if monetary policy might become subordinate to political cycles, then the entire framework that institutions use to price assets breaks down. And when the framework breaks down, institutions don't take more risk. They reduce it. They move capital into assets that sit outside the banking system entirely. Gold is that asset. It's not a liability of any government. It's not dependent on any central bank's credibility. It can't be conjured into existence by quantitative easing or destroyed by interest rate hikes. It just exists, neutral and indifferent to political drama. That's why professionals are buying it. They're not chasing upside. They're reducing regime risk. The risk that the rules of the game change in ways that destroy the value of everything denominated in dollars. When the rulebook itself feels unstable, institutions exit the rulebook. That's not conspiracy theory. That's risk management. And right now, risk management means buying gold and getting out of the way. Part 5. The quiet exit from Fiat. Now, we arrive at the heart of the story, the part that most mainstream financial media won't touch because it's too uncomfortable, too radical, too close to questioning the entire foundation of the modern economy. Ray Dalio, founder of Bridgewater Associates, one of the largest and most sophisticated hedge funds on the planet, has stated that the monetary system is ending because there is effectively no floor for fiat currency. Let me be very clear about what this is and what it isn't. This is not a prediction that the dollar will collapse next Tuesday at 3 p.m. This is a structural warning about the mechanics of fiat currency systems. Fiat means by decree. Fiat currency has value because a government says it has value, and people accept that decree as long as they trust the government's ability to manage the currency responsibly. But here's the problem. There's no physical constraint on fiat currency creation. Gold can't be printed. You have to dig it out of the ground. But dollars, euros, yen, those can be created with a keystroke. And when governments face fiscal pressure, political pressure, the temptation to print becomes irresistible. The no-floor comment is mechanical, not apocalyptic. It means that in a fiat system, there's no natural limit to how much currency can be created, which means there's no natural floor to how much that currency can be debased. The only constraint is political will, and political will is always temporary. Now here's where it gets truly unsettling. The institutions that manage the fiat system, the central banks and commercial banks, are accumulating gold themselves. They're not buying it for short-term profit. They're buying it as protection against the very system they're supposed to be defending. Think about what that signals. It's like a ship captain quietly putting on a life jacket while telling passengers everything is fine. Maybe everything is fine. But the captain's behavior suggests otherwise. Deutsche Bank set a price target of $6,000 per ounce for gold in 2026, citing persistent investment demand as central banks and investors increase allocations to non-dollar and tangible assets. Société Générale has issued similar targets. These aren't fringe analysts or conspiracy theorists. These are major European financial institutions with access to central bank flows, sovereign wealth fund positioning, institutional order books. And they're saying that the repricing of gold isn't over. It's structural. It's permanent. Here's the speculation I'll label clearly. We don't know whether this represents a coordinated reset, some kind of planned transition to a new monetary system, or just gradual erosion, as confidence in fiat currencies declines over years and decades. But what we can observe is behavior. And the behavior we're observing is that the architects of fiat are hedging against it. They're moving capital into tangible assets, because tangible assets can't be debased by policy mistakes, political interference, or loss of confidence. This is the quiet exit from fiat, not a panic, not a crash, just a slow, deliberate repositioning by the people who understand the system best because they built it. And if that doesn't concern you, you're not paying attention. Part 6. The human cost of monetary confidence loss. Let's bring this down from central banks and institutional flows and talk about what it means for regular people. Because that's where monetary policy stops being abstract and starts being brutal. Currency weakness translates directly into purchasing power erosion. When the dollar falls, everything priced in dollars that you import, which is almost everything, gets more expensive. Your rent doesn't care about monetary policy. Your grocery bill doesn't care about the Fed's dual mandate. But both get affected when the currency you earn your paycheck in loses value. Here's the cruel arithmetic of inflation. It hurts wage earners before it hurts asset holders. If you own stocks, real estate, commodities, those assets tend to reprice higher as currency devalues. Your net worth might even increase in nominal terms. But if you live paycheck to paycheck, if your wealth is denominated in cash savings or fixed income, inflation is a direct tax on your purchasing power. You didn't vote for it. You can't opt out of it. It just happens to you. Gold rallies often coincide with periods of social stress, and that's not coincidental. When monetary systems lose credibility, when people feel like the value of their labor is being stolen by forces beyond their control, it creates anger, resentment, political instability. Declining confidence in economic institutions feeds political polarization because people start looking for someone to blame. They radicalize. They lose faith not just in currency, but in the legitimacy of the institutions issuing it. This is what economists call the invisible tax of currency debasement. Governments can fund themselves by printing money instead of raising taxes explicitly. But the effect is the same. Wealth is transferred from savers to debtors, from fixed income earners to asset holders, from the powerless to the powerful. And people feel it even if they can't articulate the mechanism. They know something is wrong. They know their paycheck doesn't go as far as it used to. They know the system feels rigged. And that feeling, that ambient sense of betrayal, is what eventually breaks societies. I'm not doom-mongering here. I'm not saying collapse is imminent. What I am saying is that monetary systems fail quietly at first. The professionals move their money. The institutions hedge. The central banks accumulate gold. And regular people just feel poorer, angrier, more desperate, without fully understanding why. By the time the failure becomes obvious, by the time it makes headlines, the damage is already done. The wealth has already been transferred. The social contract has already frayed. Gold at $5,200 per ounce is a symptom of that process. It's not the cause. It's the canary in the coal mine, the market's way of saying that confidence in the existing monetary order is eroding faster than most people realize, and confidence, once lost, is almost impossible to rebuild. Part 7. What this move actually tells us. So let's resolve this without hype, without prediction, without pretending I have a crystal ball. Gold at $5,200 doesn't mean the system collapses tomorrow. It doesn't mean you should sell everything and move to a bunker in Montana. What it does mean is that trust is being repriced in real time, and that repricing is being led by the people who understand the system best. Let me differentiate price from prophecy, because this is critical. A price is information. It's the aggregate judgment of millions of participants about value, risk, and future expectations. $5,266 per ounce is the market telling you that confidence in dollar-denominated assets has declined. That's a fact. What it doesn't tell you is exactly when or how that decline will manifest in systemic breakdown. It doesn't give you a timeline. It doesn't give you certainty. It just gives you a warning. The drivers behind this move are institutional, political, and psychological. Institutionally, banks and central banks are accumulating gold as a hedge against dollar exposure and monetary regime risk. Politically, the White House is signaling comfort with a weaker dollar and openly predicting Fed policy changes that undermine central bank independence. Psychologically, consumer confidence is at 11.5-year lows as people lose faith in their economic future. Those three forces are compounding, reinforcing each other, creating a feedback loop that pushes gold higher, not because gold changed, but because everything around it did. Here's where I'll restate the speculation boundaries clearly. We don't know if this is a temporary dislocation that will resolve when political uncertainty fades. We don't know if it's the beginning of a multi-year transition to a new monetary order. We don't know if central banks will successfully defend the dollar, or if confidence will continue eroding. Those are unknowns. What we do know is that the behavior we're observing, institutional defensiveness, political interference in monetary policy, collapsing consumer sentiment, is historically associated with currency crises. Not always, but often enough that ignoring it would be stupid. So let me bring us back to the central question I posed at the beginning. Is gold rising, or is confidence falling? The answer, unsatisfyingly, is both. Gold is rising because confidence is falling. They're not separate phenomena. They're two sides of the same coin. When people trust the system, they hold paper assets. When they don't, they hold tangible ones. Right now, the migration from paper to tangible is accelerating, and the professionals are leading the way. Gold didn't change. It's the same inert metal it's always been. But the system around it did. The rules feel unstable. The people in charge are sending mixed signals. The institutions that are supposed to provide stability are hedging against instability. And regular people are being crushed by an economic reality that doesn't match the optimistic narratives they're being fed. This move tells us that something fundamental has shifted. Not overnight, not catastrophically, but shifted nonetheless. And whether that shift resolves peacefully or chaotically, gradually or suddenly, will depend on choices that haven't been made yet by people in positions of power. What you do with that information is up to you, but pretending it's not happening, pretending gold at 5,200 is just another rally, just another speculative fever that will fade when the excitement dies down, that would be a mistake. Because the people buying gold right now aren't excited, they're terrified, and they have access to information you don't.